Beyond income from traditional sources like stocks and bonds, strategies like CLOC, seek income in attractive areas that many investors miss. So why do these strategies suddenly seem much more relevant today?
Many income-focused investors sort of relied on the 60-40 toolkit, right, of stocks and bonds. But today's market environment is pushing advisors and investors to think more broadly. We pair that with, well over 5,000 ETFs in the marketplace, and there are a tremendous amount of opportunities out there. One area that has been gaining increased attention over the years is the collateralized loan obligation market, or CLOs. And this area of the market, historically has really been only accessed by institutional or specialized investment professionals. But the growth of ETFs, the growth of actively managed ETFs has made this asset class much more easily accessible for both institutional and retail investors. So again, we're awfully proud. CLOC, the AAM Crescent CLO ETF, is one of the newer ETFs to our lineup. We think it's a rather unique solution, but that's managed by one of the strongest managers in the CLO space, Crescent Capital, which goes back to issuing the first CLO back in 1993. So again, we're talking about an active strategy managed by a manager that knows the space extremely well. And the other differentiator for CLOC over many of the other CLOs, nearly 30 of them in the marketplace right now, is that many of those strategies, albeit active strategies, they focus on specific tranches. So it may be AAA or BBB exposure. The unique aspect of CLOC is that it allows the sub-advisor, Crescent Capital, to find relative value up and down the entire spectrum of the investment grade CLO market. So again, it provides them some flexibility in finding that relative value that, quite honestly, other ETFs might not be able to achieve. So again, you pair that with the lowest cost active CLO in the marketplace, and this is a product that we think can help advisors and investors achieve elevated levels of income, mitigating duration risk because of the floating rate nature, and also provide added diversification portfolios as well.